Good afternoon. This is Sean Golding with Golding and Golding, here to discuss the basics of foreign income and U.S. tax for U.S. persons. So, first order of business is to identify what a U.S. person is. For the purpose of this presentation, we're just going to focus on individuals. U.S. persons generally comprise three categories. You've got your U.S. citizen, either by birth or naturalization, including dual citizens. You have a legal permanent resident, aka green card holder, and the third catch-all category, because the IRS isn't going to let you go if they can get you, right? A visa holder or foreign national. So you don't have to have a visa. It's common if you have one, like an H-1B, L-1, EB-5, E-2, E-3, O-1, etc. Or not, B-1, B-2, if you're a tourist even. And you're in the United States for a certain amount of time over a 3-year period using a 1-to-1, 3-to-1, 6-to-1 ratio. I think it comes out to like 121 days every year, but it doesn't have to be that way. It's generally at least 30 days in the present year, and then you use the 3-to-1, 6-to-1 ratio for the prior years. Anyway, if you meet that test, guess what? You're considered a U.S. person, and all these ridiculous tax rules are going to apply to you as well. So the U.S. follows something called worldwide income and citizen-based taxation, which is a misnomer because you don't have to be a citizen to get stuck in this matrix. You could be any one of the categories of U.S. persons identified above. And so basically, as a U.S. person, it's not just U.S. sourced income. It's U.S. sourced income and non-U.S. sourced income. Typical example is you could be a citizen living in Brazil, earning all of your money in Korea and Japan. Guess what? All of that income is still taxable, even if it wouldn't be taxable in the country of residence. Now, even though the U.S. follows the worldwide income taxation model, there are treaty benefits that may be available. There's different types of treaties. We're going to focus on the bilateral tax treaties. There's also estate tax treaties. There's about 16 of those. There's totalization agreements, FATCA agreements. But the income tax bilateral tax treaties is what we're going to focus on here. I'll give you a common example that we deal with here. It's with foreign pension. So a taxpayer can come to us. They have a significant amount of money in their pension in the UK. Under most circumstances, based on the treaty, if it's I shouldn't say legitimate, if it's an approved retirement, not like a QROPS, which is very common for UK citizens with Malta. They have their own, kind of tax nuances there. But from the US, if it's your kind of regular pension and it's in the UK, then most of the time it's not going to be taxed during the growth, almost all the time. When it's distributed, it's generally taxed in the country of residence, but there's a very healthy tax treaty between the US and UK, and so some of that may be exempted. It may only be taxed in the UK or the US. You got to really look into that when dealing with the UK. Conversely, if you're looking at Singapore, same client may come in, maybe they have $500,000 in their CPF, which is a mandatory compulsory retirement fund in Singapore. There is no tax treaty with Singapore, so there's no 8833 to rely on. And back in 1996 and 1997, the IRS issued two letters, two memoranda, two correspondence. They basically said, the first one said, look, the contributions for U.S. persons into that CPF is taxable. You don't get that 401k treatment where it's not tax a contribution, just a distribution. The second is the growth within the fund is taxable. So while the gentleman in the UK has a same amount of retirement growing in the UK, well, that's probably not taxable. If that same money was in the CPF, the U.S. can tax you on the growth. So it's very lopsided, it's very unfair, since plenty of people come to the U.S. for a while and then go back, let's say Singapore, to live, to retire. May not have been taxed on that income or taxed at the same rate. What are some common sources of foreign income? Foreign employment or consulting, of course. You work for someone, you've got some vendors out there that pay you, 1099 equivalent, W-2 equivalent. Foreign real estate, this one gets a bit tricky. If at the end of the day, you have rental properties that net a loss, that doesn't mean you don't have income, it just means you don't have any profit, right? So the IRS still wants to see that all laid out and itemized on what's called the Schedule E most of the time is in Everett, the income, expenses, marketing, commissions, management fees, repairs, etc., etc. In addition, in some countries, there's a threshold before you have to start even reporting real estate income. Even if you're below that threshold, if you're a U.S. person, you should still include that income on your U.S. tax return. The U.S. isn't going to follow those laws. Other passive income, your interest, your dividends, your capital gains. If you have, you may still be able to get qualified dividends on foreign dividends if you meet the requirements, if it's a certain type of company, if it's traded on the NASDAQ equivalent, things like that. Interest, a common situation we see is someone will have fixed deposits or certificates of deposits in different countries. Even though you're not taxed on the growth within it, outside of the US, in the US you are. So you don't realize that money until you get the distribution, maybe in an FD 2 years or 3 years, 12 months. In the US, you're paying tax on that growth here. If you do pay some tax over there, wherever there is, you can generally qualify for a foreign tax credit under most circumstances. Not all, but most. When it comes to disclosing unreported income, there are various avenues available depending on what your situation is. They had something called OVDP, even though they discontinued that program. They expanded the traditional voluntary disclosure. So if you are unable to certify under penalty of perjury that you are non-willful, then you still qualify for the traditional voluntary disclosure program for your offshore income. There's also the streamlined filing compliance procedures, streamlined domestic, streamlined foreign, both for people who are non-willful. The domestic and the foreign pertain to the residence of the taxpayer. Domestic just means not a foreign resident. Foreign means foreign resident. There's always a reasonable cause available either before the penalty or to abate it afterwards, and various delinquency procedures that may be available. And with the delinquency procedures, generally the IRS will waive all penalties, similar to the streamlined foreign. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.